Well, the Australian economy looks set for quite a strong year of growth in 2010. If we look at what we call domestic demand, which is the combination of investment, consumer spending, housing, etc., we estimate that grew by about 1.25% in 2009, and we think it's going to grow by 4.25% in 2010. And the growth engines for the economy will switch around from government spending and inventories that we saw in 2009 to those more fundamentally strong components of the economy, being consumer spending, business investment and housing. Of course, associated with that will be rising interest rates. So a series of 25 basis point rate hikes in the first half of this year. In the second half of the year, I think with rates at neutral and rates having moved fairly quickly from 3% to 4.5% over less than a year, the central bank will take a pause. And I believe one of the other factors behind that pause being taken is that growth will lose some of its steam in the second half of the year relative to the first half of the year. And a lot of that's going to be associated with concerns about Australia's banks' capacity to fund the economic environment. The global economic crisis, many argue the global economic crisis is over, but it's not forgotten. In my view, it's forgotten, but it's really not over, because there are still great difficulties that the Australian banking system has in financing itself offshore, and I believe that's going to show up in banks being more reluctant to lend than we've seen in previous cycles. That's going to put some modest brakes on the economy in the second half of this year. If we switch to the world economy, the two key questions are, is the current policy-induced potential slowdown in China going to go a lot further? And secondly, is the current policy-induced recovery in the US sustainable? China's important for Australia because of commodities and because of the Australian dollar. And the US is important because of credit markets and equity markets. Firstly, on China, my view there is probably more optimistic than the consensus. I think the Chinese authorities had such a shock in 2008 when they over-tightened at a time when their export sector was falling apart, that they probably vowed not to repeat that mistake again. A lot of the growth in credit that we've been seeing is directly associated with the government fiscal stimulus. Sure, they'll rein back bank lending, but I don't think that they'll risk any substantial slowdown in the economy. The equity markets are not bubbles. Inflation in China is not out of control, and the Chinese realise the key is to be able to generate enough growth to maintain employment, to keep people off the streets and demonstrating. So my view is that people are overreacting to the recent information on China's tightening policy, and we can expect to see that Chinese economy growing by about 9% this year. With the US, I think it's entirely the opposite story. I think the US authorities have pretty much made it clear that the available stimulus is going to be pretty much used up by the middle of this year, that the economy will have to be on a self-sustaining growth momentum by then, and I just don't think that that's going to happen. I think the criticism that the banks have come under in the US over the last few weeks is going to make them even more gun-shy to lend. We've seen the biggest collapse since the 1930s of credit in the US, and my view is that credit recovery that'll be required to put that economy back on a slow, steady growth pace is just not going to be there. So I think that we're in for some unfortunate shocks in the US this year, and so I guess my view on the US recovery is much less optimistic than would be the consensus view, which is talking about 3 to 3.5% growth. Now, what does that all mean for financial markets? Well, I think it means a lot of volatility for financial markets. I believe that the recognition that the US equity market has probably been overreaching its expectations for the US economy is going to lead to some down thrusts in global equity markets. But I would expect that at some stage over this year, global equity markets will start to realise that the drivers of the Australian economy are not the US economy, but they're the Chinese economy and the overall recovery in Asia. And we'll start to see a wedge open up between our equity market and the performance in the US. That, of course, will be a similar story for the Australian dollar. I think the dollar will initially be dragged down by concerns about China and evidence on the US, but I think by the second half of the year, the dollar will be surging forward. So for the second half of the year, I would expect to see some issues with regard to the availability of credit, but interest rates will be on hold. The equity markets will be recovering, and we'll certainly see a stronger Australian dollar.